Has you ever wondered what really happens, like behind the scenes when you send money across borders? Or maybe why buying something from an international website, well, it felt a bit more expensive than you thought it would?
Hmm.
It seems so simple on the surface, right? Just the click. But underneath, it's a real financial labyrinth. So today, we're diving deep into this, into the intricate world of cross-border payment processing. Our mission for this deep dive is really to pull back the curtain. We want to unpack the big challenges that payment processors face in just making global transactions happen smoothly. We've got a whole stack of sources here, everything from really detailed reports on, complex regulatory frameworks to analyses of cutting-edge emerging tech. And we're going to try and extract the most important nuggets of knowledge for you.
Indeed. And it's funny, while cross-border payments are absolutely fundamental to modern global commerce, the system itself, well, it wasn't really designed for today's seamless e-commerce world. It's more like a patchwork, something that's grown organically over decades. And that leads to complexities far beyond what you'd see with a simple domestic transaction.
Right. And we're talking about everything, aren't we? From constantly changing global rules to those really frustrating hidden fees, security threats popping up all the time, and even this clash between, old clunky technology and shiny new innovation. This is where it gets really interesting. Okay, so let's unpack this first one. The first major hurdle, you mentioned regulations. It's the sheer complexity, right? It's not just one neat set of rules they have to follow.
Absolutely not. The regulatory environment is incredibly intricate, and crucially, it's always evolving. Payment processors, they're subject to really stringent anti-money laundering AML regulations all over the world, plus know your customer KYC and counter-terrorist financing CTF protocols. I think the key takeaway here isn't just the number of rules, but how this global patchwork creates this ongoing resource-intensive compliance marathon.
So it's not like a static checklist you can just tick off and you're done. It's more like a living, breathing challenge that needs constant attention.
That's exactly it. That's a crucial distinction. It demands this continuous, really resource intensive process of monitoring, interpreting, implementing regulatory changes across numerous and often conflicting legal environments. This means significant investment in what's called RegTech, regulatory technology solutions, specialized software, basically. And it needs a lot of dedicated compliance expertise, people who really know this stuff inside out.
And it's not just about stopping money laundering, right? I mean, data privacy must be a huge piece of this puzzle, too, especially when you're moving personal info across borders.
That's right. Yeah, the seamless flow of personal and financial data is vital for these fintech companies, but it faces intense regulatory scrutiny. You take the EU's General Data Protection Regulation, GDPR, it imposes really stringent conditions on data transfers outside the European Economic Area. It requires what they call an essentially equivalent level of data protection. And recent rulings, like the landmark Schrems 6 decision, well, they've made it even tougher. They challenge the validity of standard contract clauses, SDCs, unless companies do extra homework, basically. These transfer impact assessments, or TIAs, to make sure the data is truly safe.
Wow. Okay, so imagine trying to operate globally. You've got EU customers, US customers. Maybe you're dealing with someone in a country that's flagged as a country of concern, and you're trying to satisfy all these different, potentially conflicting regulations. It sounds like you're walking through a legal minefield.
It truly is. This sort of extraterritorial reach of data privacy laws combined with new national restrictions. Like there's a new U.S. Department of Justice rule coming into effect in April 2025. It broadly defines sensitive personal data and actually prohibits certain cross-border data flows to specified countries. It creates this really complex, potentially conflicting legal minefield. It means companies need comprehensive data flow mapping, rigorous TIAs, ongoing legal counsel. Basically, a constant dance with the lawyers.
And what happens if they get it wrong? I mean, what are the actual stakes for the companies and I guess ultimately for us, the users?
Well, noncompliance carries severe consequences. For GDPR, fines can go up to 20 million or 4% of a company's annual global revenue, whichever is higher. That's huge. Similarly, not sticking to the payment card industry data security standard PCI DSS, the rules for credit card data that can lead to fines from $5,000 to $100,000 a month. But beyond these hefty fines, there's significant reputational damage, potential loss of market share. So ultimately, for any business or individual relying on these services, understanding this regulatory dance is really critical. It ensures your money and data are moving safely and, importantly, legally.
Okay, so we've kind of navigated that complex regulatory maze, clearly massive financial and legal implications there. But let's move from the rules and fines to the actual money itself, because I think for most of us, the first thing we notice about international transfers is just how expensive they feel. Why is that?
Yeah, the costs are inherently higher. It's down to a multitude of fees, and also the unpredictable nature of currency exchange rates. These factors significantly impact a payment processor's profitability, their cash flow. You're looking at things like foreign transaction fees, typically maybe 1% to 3% of the total transaction amount. These get imposed when a transaction goes through a foreign bank or involves a foreign currency. Then you have currency conversion fees, which can be a fixed amount or a percentage.
But the really tricky ones are often hidden in plain sight, aren't they? Like the exchange rate itself that you actually get.
Exactly. That's a big one. There's the exchange rate margin, often called the FX markup. It typically ranges between maybe 1% and 3.5%, and it's added by financial institutions on top of the interbank rate. That interbank rate is the rate banks trade currencies among themselves, the real rate, if you like.
So you're not getting the rate you see on Google Finance, for example.
Usually not, no. This markup functions as a kind of hidden cost, and it can substantially reduce the amount the person at the other end actually receives. And on top of that, you've got wire transfer fees, often flat rates, maybe $10 to $50 per transfer, especially if you're using networks like SWIFT. SWIFT is essentially the global messaging system banks use to send secure payment instructions. And perhaps the most opaque, the least clear, are the intermediary bank fees. So when your bank doesn't have a direct link to the recipient's bank, these third-party intermediary banks step in to route the payment.
Okay.
And each one of those can deduct its own fee, often without telling you much about it up front. SWIFT transfers commonly involve, say, 1 to 3 intermediary banks, each charging maybe $15 to $50. So the total fees can easily range from 1% to 4% of the transfer amount just from these intermediaries.
Wow. So it's like this cumulative effect of multiple, often hidden fees that creates this substantial hidden tax on moving money across borders. It's like ordering that pizza and then finding out there's a dough kneading fee, a sauce spreading fee, and maybe an oven heating surcharge you never budgeted for.
Precisely. That's a great analogy. And this phenomenon, it really disproportionately impacts smaller businesses. It significantly erodes their profitability. The lack of transparency, the multiplication of these fees across this complex multi-bank chain, it makes accurate cost prediction and management incredibly difficult. It just silently eats away at margins.
And beyond the fees themselves, currency volatility must play a big role too, right?
Yeah.
Especially if payments take a while to settle.
Oh, it's a huge factor. Currency volatility introduces significant currency risk. It directly affects the value of payments received or sent. So, for example, if it gets converted, the business just gets less money than they expected. And B2B transactions, business to business, they often span 30 to 90 days from invoice to payment. That exposes businesses to these prolonged exchange rate movements that can seriously erode profits, or sometimes lead to unexpected gains. But it's the uncertainty that's the killer. This unpredictability, it's made worse by the fact that currency predictions are notoriously inaccurate. So this isn't just a cost factor, it's a fundamental risk. It can undermine financial planning, budgeting, and ultimately, yeah, these high costs and risks often get passed on to you, the customer, making products more expensive or potentially reducing a business's competitiveness globally.
It seems almost counterintuitive, doesn't it?
Mm.
In our hyper-connected world, you'd think money would just move instantly, like my domestic bank transfer.
Mm-hmm.
But that's really not the reality for cross-border payments, is it?
Far from it, unfortunately. Despite all the advancements in fintech, traditional cross-border payment systems are still plagued by these systemic inefficiencies. Cross-border B2B payments, for instance, typically require an average of 2 to 5 business days to settle.
2 to 5 days? Seriously? In, what, 2025?
Yeah.
Why the delay? That's genuinely shocking.
Yeah, it seems crazy, doesn't it? This protracted timeline, it primarily boils down to how traditional banks are interconnected, or rather, how they aren't directly connected. Your money doesn't just zip from account A to account B internationally. It often journeys through this complex web of different banks, clearinghouses, local financial institutions. Each intermediary, including that huge SWIFT network we mentioned, used by over 11,000 institutions. Each step introduces potential delays, extra fees, and points where things could go wrong. And then you add in things like different time zones, bank holidays, sometimes even manual checks. It all adds up. This fragmented, multi-intermediary patchwork of older legacy systems, it fundamentally gets in the way of real-time settlement. It creates what some people call a systemic liquidity trap for businesses and payment processors.
So liquidity trap, what does that mean exactly?
Well, imagine your business's money is like water flowing through pipes. In cross-border payments, that water often gets stuck in various pipes and holding tanks within the system for hours or even days. That's the liquidity trap. Your funds are locked up, trapped in transit, not available for you to use, which is a huge problem for businesses needing agile cash flow management.
Right. So it's not just about the speed, it's also about managing your capital that's tied up in the system. That sounds like a significant challenge for the financial institutions themselves, too.
It absolutely is. Financial institutions, they're required to maintain liquidity, basically, have cash available in multiple currencies across various countries. This often means they have to pre-fund these special accounts called nostro accounts. Think of it as a bank holding an account at another bank in that foreign currency. They have to do this in numerous jurisdictions. This practice ties up significant working capital, restricts financial flexibility, especially for smaller institutions, and the fragmented infrastructure, diverse regulations like foreign exchange controls. It all complicates liquidity planning, particularly in emerging markets. So this really moves beyond just a simple liquidity concern. It becomes a strategic operational hurdle that directly impacts a payment processor's ability to scale up to enter new markets efficiently.
And for you, the individual or the business using these services, how does this actually translate into your everyday experience? What do you see?
Well, what you often don't see is real-time transparency. Many traditional B2B payment processes are quite opaque. They lack real-time tracking capabilities.
Hmm.
So businesses are often left uncertain about the precise status of their transactions. Where is my money right now? The transaction information is frequently fragmented across different systems, making it really hard to track a payment or pinpoint the source of a delay if something goes wrong.
Which must be incredibly frustrating.
It is. And it's not just an inconvenience. It has tangible negative consequences. Increased fraud risks, accounting headaches, difficulties in cash flow management, and damaged customer trust, especially when recipients get less money than expected because of hidden fees or bad exchange rates they weren't told about. This inability to track payments in real time means that when a problem does arise, payment processors and their clients are often flying blind, unable to proactively diagnose or resolve the issue quickly.
Okay, so as money moves across borders, with all these delays and complexities we've talked about, it must surely attract a lot of bad actors, right?
Yeah.
What are the biggest security concerns here?
Oh, absolutely. The global nature of cross-border payments inherently amplifies security risks. Payment processors become really attractive targets for increasingly sophisticated fraud and cyber attacks. First off, data breaches are a constant major threat. These systems handle immense volumes of sensitive data, credit card numbers, bank account info, personal details, makes them highly lucrative targets. Breaches can happen because of vulnerabilities like weak security, old software, maybe misconfigured systems, and the consequences are severe. Significant financial losses. The average cost of a data breach is estimated around, USD 3.92 million? Plus irreparable reputational damage, costly lawsuits, substantial regulatory fines, and the sheer volume and sensitivity of data moving cross-border combined with varying cybersecurity standards in different countries just creates a much bigger attack surface for criminals.
And beyond just stealing data, what about direct payment fraud? Are fraudsters getting smarter there too?
Definitely. Cross-border payments are particularly susceptible to various types of fraud: identity theft, phishing scams, fraudulent chargebacks. Fraudsters are employing increasingly sophisticated methods. They might use stolen credit card details or even completely fabricated identities. Chargebacks, especially when they're fraudulent, meaning the customer disputes a valid charge, cause significant financial losses and operational headaches for businesses. And the risk is higher cross-border because of those differing security standards and fraud detection capabilities between countries. A particularly worrying emerging threat is something called synthetic identity fraud.
Synthetic identity fraud. What's that?
It's where attackers combine real, maybe stolen, data with fabricated information to build these completely new, convincing digital identities. They look legitimate enough to bypass many traditional verification checks. The problem is, legacy fraud detection systems often aren't equipped to spot and counter these really sophisticated deceptions.
So it sounds like our old defenses, the traditional ways of catching fraud, are kind of becoming obsolete against these newer, more clever attack methods.
That's precisely the critical gap we're seeing now.
Yeah.
The increasing complexity of the threat landscape, it really necessitates a fundamental shift in fraud management. We need to move towards things like AI-driven real-time monitoring, adaptive analytics, systems that can learn and stay ahead of these evolving fraud trends. It's become an arms race, really.
And how do inconsistent global standards, say, for verifying customers, how does that contribute to this vulnerability?
Well, inconsistent customer verification standards across different regions for cross-border payments create significant security gaps. It's a major weak link. If you have weak onboarding processes or inadequate due diligence checks, what we call customer due diligence or CDD, you can inadvertently let fraudulent or illicit transactions slip through undetected. This absence of a universal global CDD framework leads to fragmented, sometimes insufficient verification processes. And that, in turn, increases vulnerability to illicit activities. Fraudsters can actually exploit these inconsistencies, hopping across borders where checks might be weaker. It really highlights the urgent need for a more unified, global, Know Your Customer KYC framework to foster a payment ecosystem that's both seamless and secure.
Okay, this all sounds incredibly complex. It really seems like technology should be the answer to a lot of these problems, right? Speed things up, make them more secure. But are there barriers there too?
Definitely. Yes, the vision of frictionless global commerce, it's often hampered by these deep-seated technological challenges. And a big one is the persistence of legacy systems. The global payment system, remember, it wasn't designed yesterday. It's been built up incrementally over many decades. It still relies heavily on this older infrastructure that just hasn't evolved at the same pace as modern digital marketplaces. Many big financial institutions are still constrained by back-end systems that are, frankly, decades old.
Decades, wow.
Yeah. And integrating new payment technologies with these existing, often incompatible systems is a really complex and costly undertaking. This outdated infrastructure also poses a significant barrier to adopting advanced tech like artificial intelligence, AI. AI is crucial for things like sophisticated fraud prevention or predicting customer demands, but it needs access to clean, well-structured data delivered fast.
Which these old systems can't provide.
Often, no. Legacy systems just weren't built for that. And here's the kicker. Sometimes the very inefficiencies embedded within these legacy systems can actually be profitable for some of the big incumbent players. It can create a kind of disincentive for fundamental change, for overhauling all that accumulated technical debt.
Huh. It almost sounds like these old systems are just too entrenched to change easily. They create kind of inertia.
They absolutely do. Yes, inertia is a good word. The deep entrenchment of legacy systems creates significant inertia against modernization. This perpetuates the existing inefficiencies, which, as I said, can be financially beneficial for certain stakeholders. This can lead to a lack of investment in modernization, which ultimately just maintains the status quo of inefficiency. It's a bit of a vicious cycle.
So if the systems themselves are so fragmented, does that lead to interoperability issues? Where different systems just can't talk to each other effectively?
Exactly right. Market fragmentation happens when payment networks, financial institutions, regulatory frameworks, they all operate in their own silos, lacking essential interoperability and coordination. This disjointed environment results in duplicated infrastructure, inconsistent standards, widespread operational inefficiencies. It's messy. Cross-border transactions are particularly affected. They suffer from those prolonged settlement times, partly because there aren't standardized messaging protocols everyone uses, and because of that heavy reliance on correspondent banking networks. This lack of interoperability means systems often can't communicate seamlessly. This leads to more manual interventions, which increases the risk of errors.
Right.
And this fragmentation, it directly contributes to higher operational costs for banks and merchants. It also restricts access to financial services, especially for underbanked populations. Think about it. Mobile money services in one country might not work with digital wallets in another. It effectively creates a digital border, even as the physical world gets more globalized.
Are there any efforts underway to try and bridge this digital border? Or is it just kind of the Wild West out there?
No, there are significant efforts. A really notable step is something called ISO 2022.
ISO 2022.
Yes, it's a global messaging standard. It's actually slated to become mandatory for cross-border SWIFT payments by November 2025. The promise is that it will allow for much richer data to travel with the payment, which should improve tracking and reconciliation. It's a big deal. However, standards alone aren't enough. Financial institutions also need to align their own infrastructure. Think robust cybersecurity, cloud capabilities, a more modular architecture that can adapt.
Okay, so standards help. But what about the really cutting-edge stuff? Things like blockchain and distributed ledger technology, DLT. Are they the magic bullet for all these inefficiencies? They often sound like they could solve everything.
Well, they definitely offer compelling potential solutions. Blockchain and DLT could theoretically make cross-border payments faster, more transparent, more cost-effective by cutting out some of those intermediaries. But their widespread adoption faces some significant hurdles still. First, there's volatility and price stability. If you're dealing in cryptocurrencies, the fluctuating prices are a major risk for finance teams. Although stablecoins, Those are cryptocurrencies pegged to fiat currencies like the dollar they have, helped mitigate some of that risk.
Okay.
Then you have network effects. The global economy still overwhelmingly runs on traditional fiat currency. Stable coins and other digital assets just haven't reached that critical mass needed for widespread adoption yet. There's also a pretty significant technical knowledge barrier. Implementing blockchain payments requires specific expertise, familiarity with digital wallets, cryptographic keys, and there's currently a shortage of skilled professionals who understand this stuff deeply.
And I imagine the regulations must be a complete nightmare for something so new and decentralized.
They are, yeah, that's a huge one. The regulatory landscape for digital assets is evolving incredibly rapidly, and it's still really inconsistent globally. This creates a complex, often legally ambiguous environment for businesses. Also, the immutable nature of blockchain, the fact that transactions generally can't be reversed, can clash with existing regulations that require the ability to reverse fraudulent transactions.
Ah, interesting point.
And implementing strict AML KYC requirements on decentralized platforms can be technically challenging. Plus, regulators still harbor concerns about the potential for these technologies to facilitate illicit activities. Finally, there are still challenges around scalability and throughput. Traditional systems like Visa can process thousands of transactions per second. Popular blockchain networks currently handle significantly fewer. That's a major challenge for achieving global scale. Network congestion during peak times can also lead to higher fees and slower processing on blockchains.
Okay, so while blockchain and DLT definitely hold immense promise, there's certainly not a quick fix for all the current inefficiencies. They seem to have their own set of pretty profound, multifaceted challenges to overcome before we see widespread adoption. So wrapping this all up, what does all this mean for you listening? Whether you're running a small business, you're a freelancer working internationally, or maybe just someone sending money to family overseas. We've really delved into these profound and deeply interconnected challenges that payment processors are facing every single day. From navigating that fragmented, dynamic global compliance maze to wrestling with the cumulative impact of often hidden fees and volatile currencies, we've seen how these systemic inefficiencies, rooted in old legacy infrastructure, still persist, and how processors are constantly battling increasingly sophisticated cyber threats, all while trying to figure out how to strategically integrate these promising but challenging new technologies.
It really means that the path to truly seamless, instant, cheap global payments, well, it remains pretty arduous. It's not straightforward. For payment processors to not just survive, but actually thrive and contribute meaningfully to a genuinely frictionless global economy, they need a really holistic and strategic approach. This includes things like proactive engagement with regulators, much more transparent cost structures, serious investment in modernizing infrastructure, implementing advanced security protocols, and strategically adopting emerging technologies where it makes sense.
But it doesn't sound like it's just on the payment processors themselves, is it? It sounds like achieving that truly frictionless global economy requires more of a collaborative ecosystem with everyone kind of working together.
Exactly. That's a crucial point. Payment processors, financial institutions, regulatory bodies, technology providers, they all have to work in concert together. They need to dismantle these existing barriers and collectively build a global payment infrastructure that's more efficient, more transparent, more secure, and importantly, more inclusive. One that truly supports the demands of modern global commerce.
Okay, and just to leave you with something provocative to chew on, we talked about that hidden tax of cross-border payment fees and how it disproportionately hits small businesses trying to compete globally. So think about this. What could be the broader economic impact on entrepreneurship, on innovation, particularly maybe in developing economies, if we could finally achieve truly transparent, real-time global payments? What happens when those barriers are finally broken down? Thank you for joining us on this deep dive into the fascinating and clearly very complex world of cross-border payment processing. We hope you feel a little more well-informed now and perhaps, like me, a lot more curious about exactly how your money moves around the globe.